Under modern accounting standards, legal ownership is a secondary concern. IFRS 16 focuses entirely on the economic substance of control. This framework outlines the 5 mandatory conditions that separate a true lease from a standard service contract. You need a contract that conveys the right to use an identified asset for a specified period in exchange for consideration. The presence of an asset isn't enough. If the supplier holds substantive rights to swap that asset out for a different one at any time, the contract fails the definition. It is not a lease. However, a supplier can impose protective rights, like mileage limits on a vehicle or geographic restrictions on heavy machinery. Because these rules exist solely to protect the underlying asset, they do not negate the lessee's operational control. The lease classification remains intact. Once a lease is identified, the reporting timeline begins at the inception date. This is the moment the contract is signed, the terms are locked, and the classification is assessed. But signing a document doesn't give you physical control. That happens on the commencement date, the exact day the lessor makes the asset available for the lessee to use. This second node is the accounting trigger. Financial measurement and balance sheet recognition begin here, at commencement, not at inception. Correctly identifying the 5 pillars of a lease and isolating the commencement date is the required prerequisite before any liability touches the balance sheet. The moment commencement occurs, the lessee must recognize a right of use asset. You are capturing the value of the control you now hold over the property. Simultaneously, the lessee must record the corresponding lease liability, representing the present obligation to make future payments. This side-by-side layout illustrates the shift. Historically, long-term rental commitments were hidden as simple operating expenses on the P&L. Now, the right-of-use asset and the liability are pulled forward and capitalized on the statement of financial position. Acknowledging the debt exists is the easy part. Calculating precise mathematical values for the asset and liability requires strict adherence to measurement rules. The standard's core directive is simple. If an entity exercises economic control over an asset, that asset and its resulting debt must be visible. Off-balance sheet financing is no longer an option. Initial measurement starts with the debt. The lease liability is strictly calculated as the present value of all future lease payments. To find the present value, you must follow a strict discount rate hierarchy. You first use the interest rate implicit in the lease. If that rate cannot be readily determined, you default to the lessee's incremental borrowing rate. With the liability established, we build the right-of-use asset. This structure demonstrates the 4 required components: the lease liability itself, any upfront lease payments made on or before commencement, initial direct costs, and the present value of any decommissioning provisions. This calculation contains a significant mechanical trap. The present value math changes completely depending on whether your payments are made in arrears or in advance. This timeline tracks arrears. Cash leaves at year-end, meaning each payment is in the future relative to day 0. You must discount the entire stream back to commencement. For advance payments, the day 1 payment is already at present value. Only discount subsequent future installments. Applying an arrears formula to an advance payment schedule will artificially deflate your liability, distorting the entire balance sheet. Structural precision regarding the exact timing of cash flows is the absolute baseline for determining the true size of a company's long-term debt. After commencement, subsequent measurement pulls the values down over time. By default, the right-of-use asset is depreciated on a straight-line basis over the duration of the lease term. There is one strict exception. If the lease contains a purchase option that the lessee is reasonably certain to exercise, the asset must be depreciated over its actual useful life, since the company expects to keep it permanently. The liability, meanwhile, is amortized using the effective interest method. You take the opening balance, add the finance cost generated by the discount rate, and subtract the actual cash payment made to find your closing balance. On the statement of financial position, the closing liability cannot sit as a single block of debt. It must be split out into its current and non-current portions. For payments in arrears, this layout shows the absolute fastest calculation method. The non-current liability at the end of year 1 is simply equal to the total liability balance at the end of year 2. For payments in advance, you reverse the approach entirely. the current liability at the end of year 1 is exactly equal to the cash payment due at the very beginning of year 2. These mechanics ensure that as the lease progresses, the asset and the liability burn down at asymmetrical rates. It accurately maps the physical consumption of the asset against the financial reality of compound interest. Despite the mandate to capitalize control, the standard provides 2 specific exemptions that allow entities to keep leases entirely off the balance sheet. The first is the short-term lease exemption. This applies strictly to leases with a term of up to 12 months, provided there is absolutely no purchase option attached. The second covers low-value items. This exemption relies on the nature of the asset itself, regardless of how long the lease lasts. It targets operational commodities like laptops, tablets, and mobile phones. This diagram outlines the alternative accounting treatment. If either exemption is met, the lessee bypasses the right-of-use asset and liability calculations entirely. Instead, the total lease payments are routed directly to the P&L as a rent expense, recognized evenly on a straight-line basis. These exemptions operate as pragmatic boundaries. They prevent the balance sheet from being overwhelmed by immaterial, high-volume operational clutter, keeping the focus on actual, substantive debt. The most mathematically demanding mechanism in IFRS 16 occurs when a company tries to sell an asset but keep using it. In a sale and leaseback transaction, an entity sells a physical asset to a buyer to immediately inject cash into the business, but simultaneously signs a contract to lease that exact same asset right back. This creates a direct accounting conflict. Because the original owner immediately takes the asset back on a lease, they haven't genuinely surrendered 100% of the economic control to the buyer. The financial reporting rule is absolute. An entity cannot immediately recognize the entirety of the profit on a sale if they retain partial operational control of the underlying asset. To resolve this, we use the proportionality model. We must mathematically fracture the transaction into 2 distinct conceptual pieces: the percentage of control transferred away and the percentage of control retained. Because of this fracture, the newly recognized right-of-use asset does not equal the standard cost formula we used earlier. It equals only the specific fraction of the asset's original carrying amount that the seller kept hold of. The sale and leaseback rules function as an anti-manipulation protocol. They prevent companies from booking massive revenue spikes while maintaining continuous, uninterrupted use of their critical assets. Executing this proportionality requires a precise 3-step mathematical sequence. Step 1 is calculating the exact value of the new right-of-use asset. This equation demonstrates the rule. The right-of-use asset equals the asset's original carrying amount multiplied by the ratio of the new lease liability divided by the asset's fair value. Step 2 isolates the percentage of control the seller retained in the leaseback. We define control retained, or variable X, using that exact same ratio. You divide the lease liability by the fair value and multiply by 100. This is the fraction of the asset you never truly gave up. Control transferred is simply the inverse of that number. It is 100 minus X. Step 3 determines the actual allowable profit the seller is permitted to recognize on their income statement today. The governing principle dictates that you can only recognize profit relative to the specific percentage of control actually transferred away to the new buyer. The recognized gain equals the total profit on the sale multiplied by the fraction of control transferred. This proportional math ensures financial statements remain firmly anchored to economic reality. It proves that in accounting, you can only profit from what you truly surrender.